Let's start with the thing nobody tells you. A modern car wash is not really in the business of washing cars. It's in the subscription business. It just happens to own a tunnel. But before we get to the money, a quick bit of history, because it's genuinely funny. The first commercial car wash in America opened in Detroit in 1914, and it was called the Automated Laundry, which is a fantastic name for a business that contained zero automation. Cars were physically pushed by hand through a tunnel while three guys soaped, rinsed, and dried them. It was an assembly line where the assembly line was men. It took until 1940 for someone in Hollywood to attach a winch to a bumper and drag the car through, and until 1946 for Thomas Simpson to build the first semi-automatic system with a conveyor, an overhead sprinkler, and a 50-horsepower blower to dry the car. By 1955, the operators had formed a trade association. That group still exists today as the International Car Wash Association, and its data is going to show up later in this video, so remember them. Now, the economics. There are basically four kinds of car wash, and they are wildly different businesses that happen to share a name. At the bottom, you've got the self-serve bay, the coin-op place with the wand and the timer, the one that always feels slightly haunted. Cheap to build, and revenue runs somewhere in the range of $41,000 to $80,000 a year. That's not a business, that's a side hustle attached to a piece of land. Next, you've got the in-bay automatic, the single machine that lives at a gas station and rolls back and forth over your stationary car. Call it $250,000 to $700,000 per bay to install, generating maybe $80,000 to $250,000 a year. Then there's the full-service tunnel, the old model, where humans vacuum your interior and wipe your dashboard. That used to be the entire industry. And then there's the express exterior tunnel, the one that has metastasized across every commercial corridor in the Sun Belt. You pay at a kiosk, a conveyor grabs your wheel, 100+ feet of foam and cloth and blowers happen to you, and you drive out to a free vacuum stall. Almost no labor inside the tunnel. Massive throughput. And that format has gone from essentially nothing to dominating the industry, while full service has collapsed to a small slice of the market. So what does it cost to build one of those express tunnels today? Depending on who you ask and where you build, all-in development runs about $4 to $8 million, and land is the biggest swing factor. A prime 1-acre pad on a busy corridor in a competitive Sunbelt market can run $1 to $2.5 million all by itself. The tunnel equipment package, the conveyor, the arches, the friction material, the dryers, is another $1 million to $1.5 million for a 100 to 150-foot tunnel. Add site work, stacking lanes for 20+ cars, vacuum canopies, water reclaim infrastructure, and a building that has to survive being permanently wet. That's a lot of money. What do you get for it? A mature express location typically generates somewhere between $1.5 and $3 million a year in revenue. And here's the number that made every finance person in America lose their minds. At a mature, well-run, automated express site, four-wall EBITDA margins run 35 to 50%. Let me put that in context. That is restaurant crushing, retail crushing margin. A good full-service restaurant dreams about 10%. So why is a car wash so profitable? Because the variable cost of washing one more car is almost nothing. Chemicals. All that soap and wax and ceramic coating run roughly 40 to 65 cents per car. Water and power add a bit more. Your labor doesn't really scale with volume because a modern express site runs on something like 8 to 15 employees total, and most of them are outside the tunnel greeting people and selling memberships, not scrubbing. Which means a car wash is a fixed cost business with a rounding error attached. Say your fixed costs are $10,000 a month. Wash 1,000 cars, and your fixed cost per car is $10. Wash 1,500 cars, and it drops to about $667. Every car after break-even is nearly pure profit. The industry's own feasibility benchmark for a leveraged new build is roughly 120 to 180 cars a day, just to break even. And above that line, the money gets very good very fast. Now, here's where it stops being a car wash story and starts being a Wall Street story. Because the problem with the old model was that washing cars is a terrible, lumpy business. It rains, you make nothing. It snows, you make a fortune. Revenue was weather. Then somebody had the idea to sell an unlimited monthly plan, the gym membership for your car, and the entire industry changed shape. Consider the biggest operator in the country, Mr. Car Wash. In 2025, they crossed $1 billion in revenue for the first time, finishing the year at just over 1.05 billion. By the first quarter of 2026, they had roughly 2.5 million subscription members. And those unlimited plans accounted for 76% of their wash sales. 3/4 of the money comes in on the first of the month, whether a single car shows up or not. That's not a car wash. That's Netflix with a drainage permit. And the retention is remarkable. Roughly 90% of unlimited members say they intend to renew. Industry-wide, monthly churn tends to run in the 3 to 6% range. Members wash, in a lot of cohorts, 2 to 3 times a month, and they treat the subscription like a household utility. Now, quick counterintuitive nugget, because this one surprised me. You'd assume the ideal member is the one who never comes this. You take their $35 and give them nothing. Wrong. Subscription data across more than 100 sites found that if a new member washes 1.7 times or less in their first 30 days, they're 75% less likely to stick around for a second month. Members who wash 3 or more times in that first month are 76% more likely to renew at least once. The customer who uses it constantly is the one who keeps paying. The freeloader you're secretly rooting for is actually about to cancel. So, recurring revenue, fat margins, a fragmented mom-and-pop industry ripe for consolidation, and an underlying asset. A corner lot on a high-traffic road that you can sell to a real estate investor and lease back. If you were a private equity firm around 2020, this looked like the greatest Main Street asset ever discovered. And they acted like it. At the peak, car wash platforms were trading hands at reported multiples of 18 to 20 times EBITDA and up. KKR got behind Quick Quack. Warburg Pincus backed L Car Wash. Golden Gate Capital backed Tidal Wave. Oak Tree affiliated Money backed Whistle Express. Leonard Green had been in Mr. Car Wash since 2014, and in June 2021, they took it public, where it traded above $20 a share. The construction was frantic. In 2022 alone, the industry added an estimated 943 new express locations. 943 in 1 year. You already know what happens next because you've seen it in every gold rush ever. Here's the ceiling nobody wanted to look at. The entire growth story for 30 years was conversion, convincing people to stop washing in the driveway. In the mid-90s, about half of American drivers washed mostly at a professional facility. Today, it's around 79%. That's a fantastic run. It's also nearly over, because there's a residual group of garage keepers and driveway hobbyists and people who wash their car twice a year that no price point converts. Analysts model a practical ceiling somewhere in the low 80s, so you have a demand curve flattening and a supply curve going vertical. Guess what happens? February 2025, Zips Car Wash, one of the largest privately held express operators in the country, with more than 260 locations across 23 states, files for Chapter 11. They walked in carrying $653.9 million of funded debt and about $1 million of cash. The plan shed $279 million in debt, handed the company to its lenders, and wiped out the existing equity entirely. They emerged in under 90 days, but the equity was gone. Aggressive expansion, floating rate debt that repriced when the Fed hiked, expensive leases, and new competitors opening across the street. That's the whole story. Meanwhile, Driven Brands, the company that owns Take 5 Oil Change and Meineke, had bought its way into car washes in 2020. By the third quarter of 2023, they wrote off the entire goodwill on the U.S. car wash unit, an $851 million non-cash impairment, plus more than $100 million in asset impairments, plus 29 store closures. In 2025, they sold the whole U.S. car wash business to Whistle Express for $385 million, $255 million in cash, and a $130 million seller note. That is a fraction of what they put in. Then in early 2026, they sold the international car wash business too and exited the category completely. And Mr. Car Wash, the crown jewel, the one public pure play, Leonard Green took it private in May of 2026 at $7 a share, down from north of 20 at the IPO, implying an enterprise value of about $3.1 billion. The multiples reset accordingly. Platform deals that cleared in the high teens now price in the high single digits to low double digits of EBITDA. The net lease real estate that funded so much of this, car wash buildings sold to 1031 exchange buyers, went from mid 5% cap rates at the 2022 peak to roughly 6.2 to 6.4%, which in plain English means the buildings are worth meaningfully less. And new express openings fell from those 943 in 2022 to roughly 550 in 2025. So is the whole thing a disaster? No. And this is the part that gets misreported. The Small Business Administration has guaranteed roughly $6.83 billion across 5,807 car wash loans since 2010. And over that whole period, car wash 7A loans have charged off at about 5.25% of resolved loans versus 7.45% across all industries. On a dollar basis, it's even better. The asset class everyone describes as terrifying has historically defaulted at roughly two-thirds the rate of the average American small business. The fear is attached to a vintage, the 2021 and 2022 cohorts underwritten at peak land prices and peak optimism, not to the category. Though fair warning, those loans are still seasoning, and lenders have absolutely tightened. SBA 7A approvals to car washes fell about 60%, from $676 million in fiscal 2021 to $272 million in fiscal 2025. The industry overall is still a $19.2 billion business with about 17,100 operators across roughly 19,000 locations and 181,000 workers, running an average operating margin around 14%. It's not collapsing. It's just done growing fast. Some models project it drifting flat to slightly down through 2031. A few more things you need to know if you're seriously considering this. Water. An express tunnel without reclaim pulls something like 30 to 45 gallons of fresh water per car. Reclaim systems cut that by half or more. Which, by the way, still beats you washing it in your driveway, where a running hose can burn through anywhere from 40 to 140 gallons and dump untreated soap, oil, and brake dust straight into a storm drain. Commercial washes discharge to sanitary sewer where it gets treated. But water is increasingly not just a cost line. It's a permitting question. Colorado River shortage rules, Arizona's water supply framework, California conservation rules. In parts of the Southwest, water availability now decides whether your project is even approvable. Zoning. Cities have noticed. Cape Coral, Florida, Birmingham, Alabama, Hemet, California, Perrysburg, Ohio. Moratoriums and overlay restrictions on new car washes are spreading, on the logic that they eat prime retail frontage, generate traffic, and employ very few people. Bad news if you're a developer. Quietly excellent news if you already own the entitled site across the street. And geography, the obvious play, Phoenix, Orlando, Dallas suburbs, is where everybody already built. The better risk-adjusted math right now is often the Salt Belt, the Northeast, the Upper Midwest, dense West Coast cores. Fewer washes per capita, harder land, higher barriers, and road salt, which remains the single most reliable trigger for a car wash in America. So here's the honest summary. Owning a car wash can be an outstanding business. 35 to 50% site-level margins are real. Recurring revenue that survives recessions is real. While member revenue has held up, benchmarked non-member drive-up revenue fell almost 12% year over year in one recent quarter, which tells you exactly which customer is the risky one. New builds take 2 to 3 years to accumulate the membership base that makes the numbers work, and you have to survive that ramp. But you are not buying a machine that cleans cars. You're buying a subscription business with high operating leverage, a plumbing problem, a water permit, and a piece of commercial real estate underneath it. Get the location right and the membership engine humming, and it prints. Get it wrong. Build the fourth tunnel at the same interchange, borrow at a floating rate, assume the drive-up customer will always show up, and you become a case study. The gold rush is over. The business is still here. It just requires being good at it now. If this changed how you look at your grocery receipt, leave a like, subscribe, and comment below. which business you want me to cover next.